Hello and welcome back to Context Beyond the Code. Today we have a very special episode. We have a guest here today, Elaine Doyle, who is a professor in taxation in the Chemie Business School in the University of Limerick, here with us. So Elaine, welcome to the podcast.
Thank you so much. Thanks for having me.
Yeah, so we'll just get started. We obviously are focused very much on our audience of kind of young software engineers and students and people kind of transitioning from university life to being new graduates and young professionals, and we just kind of wanted to cover some of the topics of taxation in the context of our field. So when doing some research for the podcast, I read about a paper that you did earlier on this year talking about the corporate tax rate and the history of the corporate tax rate in Ireland. And this is obviously has huge implications for us as software engineers, because so many multinationals are attracted to Ireland, and foreign direct investment comes to Ireland and provide such great jobs and job opportunities for us as young software engineers. So could you kind of give us a run through of how that came about, this low tax rate that we benefit from?
Sure. I suppose it came about after the 1950s, after sort of independence in sort of 1922 onwards. There was a real protectionist type of culture, I suppose, within the government, where it was felt we had to grow an economy ourselves and we had to become independent, and protecting indigenous businesses was a key part of that. So we had a systems of tariffs and controls and so on, and very much supporting indigenous industry. But the economy stagnated, and we had decades of, really low productivity and emigration and so on. And I suppose really there was a feeling within the Department of Finance that it wasn't working anymore. So they changed tack in sort of the late 1950s to try and dismantle a lot of the customs and tariffs type taxes that we have, and look at attracting foreign direct investment into Ireland. And that worked. But the transition to a low corporate tax rate kind of happened over time. There was various iterations, which I won't go into the technical details of, but we became, I suppose, gradually over the decades a very attractive place for foreign direct investment, particularly because of the low corporation tax rate, but also because of things like being English speaking, having really good education system. We're on the kind of edge of Europe, so there's access to Europe from that. And we're also, in these days, it'll be appreciated, more politically stable, reasonably, with no extremes on the politics side. And also in recent decades, it's become important also that we don't actually have extreme weather either. Yeah. So we're quite good in that sense. So the tax rate is definitely part of it, but it's part sort of a suite of measures that make us quite good.
It's a part of the system as a whole, more so.
Yeah.
But for the young professional who is just working for one of these multinationals in Ireland, in Dublin, or remote or whatever it is, the actual concept of income tax is probably one of the first things that they'll encounter as they become a young graduate. So I was reading back on a paper that you released coming up on 16 years ago now about the tax exiles in Ireland, and how people maybe move to different countries and aren't a tax resident of Ireland anymore. So would you do just kind of a summary of that entire kind of concept?
Yeah, it's complex, because I suppose every country, from a tax perspective, each country has their own jurisdictional legislation, and then they obviously interact, and then in some cases we've got EU directives or OECD model agreements and so on. So it's quite complex. In Ireland, we adopted the same system as the UK, where we have three concepts around residence broadly. So if you're in Ireland for 183 days or more in a tax year, and the year runs from January to December, then you're considered tax resident in Ireland. Years ago, you were considered here for a day if you were here at midnight, but they had to move that to if you're here at any point during the day, because you had people jetting off and coming back into the country to make sure that they weren't resident. So that's a kind of a short-term concept where it looks at the year. There's also a look back, so from this year and the previous year, if you're 280 days, that counts as tax resident. So that's short-term. There's then a kind of more medium-term concept called ordinarily resident. And to become ordinarily resident, you have to be tax resident for 3 consecutive years before you become ordinarily resident in the 4th year. So you have to have been in the country for a bit longer in order to trigger that status. And then finally, there's a status which is not defined in legislation called tax domicile, which is really where your permanent home is, where you feel like it's not citizenship, but it's where your economic ties and your social ties are. You know, some people will go abroad and say, well, I want to work in the States for 20 years, but I always plan to come back and retire in Ireland. So they'll never lose their domicile.
And their connections to home.
Exactly. So that's a much longer term concept. So between those three concepts, the combination of those determines how much of your income falls in under Irish income tax. So as a tax resident, Irish domiciled person, everything I make worldwide is liable for tax in Ireland. But if you came over to Ireland for 2 years and you're resident here, but you're not ordinarily resident and you're not domiciled, you're only taxed on what you make in Ireland and anything that you remit into the country. So they're quite different concepts. So it's complex. You have to look at each individual person and how long they've been here and what their sources of income are to figure out, you know, what they're taxed on. But for an ordinary person who's a graduate working in a company, it's pretty straightforward. They'll be paid a salary in the country and paying Irish tax on it. And the payroll is done through their employer, through the PAYE system. So to a large degree, if that's what you're doing, you don't really have to think about the tax. It's done through the payroll. The issue around, I suppose, people maybe remote working or working in different locations is being looked at by various international associations like the EU and the OECD, because it's really only emerged since COVID.
Yeah. And it's such a complex topic to have to deal
complex.
with, because you're dealing with people that could be on the move constantly and
Absolutely.
don't even have a fixed abode for maybe longer than 5 or 6 weeks, and they're just maybe moving from job to job.
Exactly. So they're sort of working. That's certainly, I was at an international global tax conference that the Institute of Tax ran recently, and that was one of the big issues that everyone is looking at, is how do we adapt our tax systems to still protect the tax base, but obviously you don't want individuals to be doubly taxed on the same income. So in lots of cases, you know, if you get into the weeds on this, there are double tax treaties between different countries. So each of those double tax treaties is negotiated between two countries, and they'll have different things embedded in them. But usually they work to make sure that people aren't doubly taxed. Now, what's happening at the moment is you might have people falling out of tax completely.
As a result, they're falling in between a gap somewhere along the
exactly.
the chain.
Yeah, it's probably less likely to happen to employees who will have an employer who makes a call on where they'll be taxed. But somebody who decides to set up maybe as an entrepreneur themselves, who jumps around, that's where you have a little bit of a danger, because most tax systems will consider somebody in business to be taxed in that country if they have a permanent establishment, and very little can actually trigger the permanent establishment piece. So actually most of the work is being done to make sure people aren't overtaxed rather than undertaxed.
Undertaxed, okay. Is there kind of any risk of like young professionals and young software engineers who are maybe approaching kind of professional life after college, like falling into the category of being a tax exile, where they take a remote job and maybe travel and stuff like that? And or is there kind of ways that they can ensure that they're complying correctly with tax? Because I know you said that it's often the case that a lot of the legislation is in place to ensure that you're not getting double taxed if you're maybe living half your year in Ireland and half your year somewhere else. Is there kind of ways that they, as young engineers, we can be aware of that when going into the field of work?
Yeah, I mean, I think you need to take responsibility for making sure that whoever your employer is, if you're employed, that you engage with, you know, the HR function and the finance function to kind of flag, well, look, am I triggering anything by, you know, if I'm going to be in Dubai for 6 months working with a company, does that have an impact on my tax position, or on particularly on pensions as well, is another thing to consider. So I think if you kind of take responsibility of asking the questions, and then there's, you know, these days, and you know, your software engineers, I mean, people are using Gen AI to ask questions. I wouldn't rely on the information you get, but it's a good starting point sometimes to explore something, ask for sources, and then be able to check up sources yourself. And certainly there'll be more, I think, commentary on digital nomad type status coming out of the OECD and the EU. So, you know, I think there will be information for people who want to seek it out.
Yeah, it's likely something that they'll have to decide on across the board as opposed on a country by country basis, because it's so variance on the movement of people, which is so common, of course, in the European
and that's where the OECD comes in really strongly, because they have various they have a network already. They've done a lot of work in the tax space, and so they've got expertise, and it's much easier for an international organisation like that to come up with best practice that then all of the other countries adopt, rather than everybody trying to figure this out themselves.
Yeah. Of course. In the time since you wrote that paper about Ireland's tax kind of culture, maybe towards employees and how that attracts tax exiles, do you think the culture has changed in Ireland over that time, and do you think we're moving in a certain direction, or is that kind of maybe above our heads at an EU level or something?
No, I mean, I think the Irish revenue have invested very heavily in very good software, actually, and they would be sort of best in class in terms of some of their systems, not only to collect data but also to collect third-party data. So they'd even have access to banking data that's triggered by suspicious transactions. So if a bank thinks something looks a bit funny, it's over a certain amount, or it looks like it's coming in from something that's not routine, they have the revenue have power to request that information, and so there's so much almost surveillance going on that it's very hard. You'd have to think very deeply, I think, about am I willing to not pay tax on this? So I think to some degree that creates a more compliant society where non-compliance is not normal,
and it's difficult to do in the confines of what the system is currently set up to be, which is quite comprehensive.
Which is I mean, people pay tax and contribute because they want to avoid punishment or fines, or because, and this has been proven in the literature, they will also do it for altruistic reasons, to contribute to society because it's the right thing to do, for religious reasons, for all sorts of other reasons other than just the punishment. But if you take the combination of those two, what tax authorities tend to do is they'll have almost the carrot and the stick. So they will invest in making sure that the public feel they're trustworthy. They respond to queries, they'll help you out if you need assistance, but also if they find that you're deliberately non-compliant, they're going to whack you with a fine. And with the amount of information they have, and as the software gets and as the I suppose the digitalization gets better and better in spotting patterns, it's very hard not to be compliant. I wouldn't recommend it.
Yeah, exactly. Well, that kind of answers my final question of, you often hear of people who just when they're talking about earning high salaries and stuff like that, are saying, oh well, I'm losing X amount of tax, and it's often a case where they're trying to find ways, or trying to see if there's ways to pay less tax, or that's where the draw of emigration comes from, of course, like that. And what would you say to those kind of young earners who are living and domiciled in Ireland, or maybe thinking of emigrating and stuff like that, about staying in Ireland and contributing to kind of tax base, and what would you how would you address those people?
I mean, I suppose tax at its fundamental, the fundamental kind of philosophy, I suppose, is this social contract. So you pay your taxes, and then you drive on roads and you turn on the tap and there's clean water and the air is reasonably clean and there's guards on the street and there's schools and there's hospitals. And when you think about it, it's so we gather money from everybody to fund that for an entire society. So even if I have no kids going to school, I benefit from living in an educated society. So we benefit both directly and indirectly from the taxes that we pay, particularly in countries where the taxes are actually being used for those things. So I think, you can go somewhere else and pay less tax, but you may not have that social sort of tightrope isn't the right word, but I suppose safety net. That's what I was looking for. Thank you. Safety net of actually what happens if you have to go to hospital, or what happens if you lose your job. So in a country that's in Ireland, there are those safety nets. So I think I think we have a responsibility to pay. I think the tax is probably a bit high on income tax at the moment, and we get into the higher net quite quickly. And because inflation has gone up, you have people paying quite high tax that are not wealthy.
The cost of living is rising with it, of course.
So I think that's something that needs to be addressed. But overall, I I think tax is it's there to fund public service, and we all need that public service.
Yeah, and I think at the end of the day as well, it comes back to the fact that people maybe too often focus on the bottom line or the number on the payslip instead of thinking about the actual society that they're living in as a result of that. Okay, thanks Elaine. Thanks for all the information you imparted with us today. It was really interesting to kind of hear about something that maybe isn't traditionally covered in our kind of field and our learning during our time here. So it's really interesting to hear not only how this affects us going into the professional world, but how it will affect us down the line when we're actually earning, and kind of remembering that core concept of that it is part of this social net and this that we're all paying in for social goods. So it was really interesting to hear your thoughts. Thank you.
Super. Thanks for having me.
Thank you.
I want to thank everybody for listening to this podcast series. Any additional information about the case studies or anything we talked about will be in the description.